Direct taxes vs indirect taxes. Direct taxes. Direct taxes are charges imposed directly on the taxpayer, and they must be paid directly to the government by the individuals or entities on whom they are imposed. This means that the person or entity that owes the tax cannot pass it on to someone else. In simpler terms, if you're subject to a direct tax, you have to pay it yourself. A key example of a direct tax in India is income tax. This tax is levied on the income earned by individuals and businesses, and it's paid by the earners directly to the government. Indirect taxes. Indirect taxes work differently. The taxpayer in this case is like a middleman or conduit. At each stage of production or distribution, the tax is added to the cost, and it's passed along until it reaches the end consumer. This means that the actual burden of the tax falls on the consumer, not the intermediary entities. The incidence, or impact, of an indirect tax is felt by the consumers who ultimately use or consume the product or service. However, the immediate responsibility to pay the tax might rest on someone else, like a manufacturer, service provider, or seller of goods. Indirect taxes are often referred to as consumption taxes. They are considered regressive because they don't take into account a person's ability to pay. This means that everyone, regardless of their financial situation, pays the same amount of tax on the same product or service. In India, there used to be various indirect taxes like excise duty, customs duty, service tax, etc. However, on July 1, 2017, a unified indirect tax system called Goods and Services Tax (GST) was introduced. GST replaced many of the older indirect taxes and streamlined the system. Remember, it's important to have both direct and indirect taxes in a tax system. They work together to create a balanced and fair way to collect revenue for the government.